two things. One is my mid-year sort of compendium about what's going on in the real estate market in Las Vegas as we get through the end of the first half of 2024. And the other is some updates about some really important issues I want to make sure you're aware of, because the real estate industry itself is right now undergoing really significant changes, and they're going to impact you. Whether you already own property and you're thinking of selling, whether you don't own property and you're thinking of buying, or you're thinking of a replacement property, or you want to make some investments, these changes are going to impact you. So stay tuned, but let me just give you a little bit of proof about exactly what I'm saying. I am Justin Miller, principal and co-founder with the Chong Miller Group, and at the Chong Miller Group, we help people build wealth through real estate. I'm not making it up. Actually, real estate is the number one source of wealth creation in this country. It has been for a long time, and it remains such. This one client bought a condo for $205,000 in May of 2019, and we just sold that same condo in June of 2024. So he owned it for 5 years and a couple weeks. He bought at $205,000, he sold at $350,000. That means he made $145,000. That means he made a 59% gain on his investment, or an 11.7% annualized rate of return. But wait, it gets better. Now, he happened to pay cash, so that was his return. But you don't need to pay cash. What if he'd put in 10% and bought the property with the mortgage? He would have put in $20,500. He would have ended up with that same $350,000 sale. He would have made 7 times, right? He would have made, from $20,000 investment, he would have made $145,000 of gain, 7 times his money in 5 years. That's over 100% return per year. That's a phenomenal return, and you're not going to duplicate it in the equities markets, in the bond market. You're not going to duplicate it at the racetrack or at a casino, right? The only possibility is if you're really good as a day trader with perfect timing, you could do that kind of thing on Bitcoin. You can make real money in real estate. Now, that doesn't mean everybody's going to, right? So let me talk about this other client of mine. Bought a house, actually about a month after that, in June of 2019 for $561,000. He sold in July of 2024 for $881,000. So 5 years again, actual client, actual numbers, made a gain of $320,000. That's a 57% return over 5 years, 11.4% annualized return. But this particular client did actually put down a down payment and used a mortgage, put down about 25%. So put down about $130,000. So his $130,000 that he put down on this property gave him $320,000 worth of return over 5 years. So about a doubling, right, on the return. So 200% of gain over 5 years. So if we divide that by 5, that's a 40% per year return on that particular buyer's sale, right? You can make real money in real estate. Now, I've had another client who, before they met me, they had had 7 properties, and somehow they've managed to lose money on each of those properties. With me, they bought a property, and a year and a half later, they had a $100,000 gain. They sold and took that gain. I'm not saying that you should use property like a bank. I'm not saying that you should buy property speculatively, but I am saying if you have a knowledgeable agent who helps you get into a transaction and helps you get out of a transaction, there is real wealth to be made in real estate. And your returns are safer, they're more probable than with any other kind of investment. And by the way, both of those clients, they were primary residents. That means they were living in the property too while they were getting those gains. They weren't paying rent. They were increasing the value of their money alongside of living in a place that they really liked. And now they've both decided time to take that money off the table and go into another transaction. These are real wealth generating vehicles. They're duplicable, and I can help you get into, get through, get out of the transactions one after another, right? You can literally build wealth through real estate. And for those of you who think, well, maybe I've missed out because that house that had the $320,000 gain is $881,000 now. You don't start at the top of the market. You don't start in the middle of the market. You build your way up. All right. First of two major issues I want to talk about here. I want to give you some information about how the market looks in the middle of 2024, what's been going on over the first half of the year and what's likely to go on over the second half of the year. The second thing I want to talk about in this video is I want to talk about some really significant changes happening in the real estate industry. So let's go ahead and dive into the mid-year review first. So at the end of July, we're up actually 9.8% on median sold price for single-family housing here in the Las Vegas Valley, almost 10% in the first 7 months of the year. Now, those of you who watched my videos for a long period of time, you know that every November I do a market forecast where I look into the year ahead. And I suggested in my market forecast from November of 2023, looking at 2024, we were likely to see price appreciation of up to about 20% in single family homes. Now, a lot of people pushed back on that. I will tell you that Bigger Pockets had forecast a loss this year, subsequently upgraded that to a gain of about 3% for the year. Remax had forecast basically flat. Redfin had forecast a small loss for the year. Zillow had forecast prices were going to be coming down. Goldman Sachs had forecast, I believe it was a 3.4% increase in prices during the course of 2024. And I was saying, no, we could be looking at 20%. Now, my forecast had been predicated on interest rates coming down throughout most of 2024. Interestingly, those other forecasts, they also were predicated on interest rates coming down. Well, I've been a lot closer, and unfortunately, we were all wrong. Interest rates have not yet come down. So from January 1st through the end of June, interest rates were holding pretty steady at around 7.0%, slight fluctuation higher and lower. In fact, through the first half of July, same thing, right? Interest rates sort of fluctuating between 6.9 and 7.1%. High interest rates all of 2024. Now, rates in the second half of July did start to come down, but part of that was a knee-jerk reaction in the bond market, the equities market, and the mortgage bond market relative to some bad news on the employment front, where the unemployment numbers looked not so amazingly great for the month of July when that data came out the first Friday of August. And in fact, what we saw was slowing job growth. Now, job growth came in at about 140,000 new jobs relative to the forecast about 180,000. And so that caused a lot of consternation in the political environment and the news environment, and that manifested itself in a significant but one-day correction in the equities markets. And we saw the same thing spill over to interest rate environments. And a lot of sudden calls for the Fed, you've missed your opportunity to lower interest rates, we're going into a recession, et cetera, et cetera. The reaction, very overblown. I do think the Fed has been holding interest rates way too high for way too long, but that's not associated with a particular headline that came out on a particular day. So we've seen interest rates come down and bounce back up. And as I record this in the middle of August, average interest rates for a 30-year fixed rate loan, sitting about 6.86%. So we're a little below that 7% level, but not a lot. It means interest rates have been holding relatively steady throughout 2024. And so I need to update my forecast based on these higher interest rates. But even with high interest rates, higher than anticipated, Prices have gone higher. They've gone higher 9.8% through the first 7 months of the year, which means if we duplicate that for the remaining 5 months of the year, we'd be pretty close to my forecast of 20%. I don't think that's going to happen because there are some other issues taking place before us for the remainder of the year. I'll talk about in just a second, but I want to give you a couple more interesting pieces of statistics. So, median sold price in July, the end of July, $480,000. But let's go back to the end of June, the halfway point. $470,000 at the end of June. The median list price, however, was $574,900, almost $105,000 above the median sale price. What does that mean? It means that even though we have low inventory, much of the inventory is mispriced. It's priced really high. It's priced 20% too high. So mispriced inventory is not selling. Bad condition inventory, not selling. So when we look out there and we say inventory is low, which it is, I'll get to in a second, we're actually really only able to look at about half of the inventory because the other half is just priced inappropriately high. That's a problem for listing agents and for sellers. Listing agents are not helping their sellers by listing prices that are just way too high, right? So, okay, let's look at some demand measures. Right, and in my market updates, I always tell you sold transactions as well as pending transactions. Those are our two demand measures because you don't get a sale unless you have somebody who's trying to buy, someone who's showing demand. All right, so very interesting. Normally, I look at information on a month-to-month basis. So in this month, this happened, comparison to that month, etc. But we can accumulate the numbers as well. And so if we look at the numbers over the first half of the year, we'll see something interesting here. In 2023, we had the slowest transaction volume in a generation because of high interest rates and because of low inventory. Number of total transactions that took place in 2023, really low relative to the norm, really low. I mean, literally a generation of time has gone by since we've seen numbers this low again. Well, let's look at the first half of the year. In the first half of 2023, we saw 12,142 total sales for single-family homes. Really bad, right? We should be a lot higher than that. We should be over 16, 17, 18,000 for number of sales over a 6-month period of time. This is really low. So how do we look in 2024? For 6 months, January 1st through the end of June, 12,382. We are up 2.0% for total number of transactions over the first half of the year. So we're looking better, not hugely better, but better than we did in 2023. And we're still looking really slow, really low number of transactions relative to what we'd be expecting in this market, where during the course of the year, we may expect 36 to 42,000 total transactions. We're really running low, right? So that's something to note. All right, well, what about on the supply side? Well, I mentioned to you listings, the median listing, $574,900, $105,000 higher than the median sale. Those numbers are from the end of June. Price ranges in the inventory that's listed. It's kind of interesting information. The least expensive single-family home listed at the end of June was $140,000. Now that's pretty cheap, right? A lot of people might be saying, oh, I want that, I want that. Well, you may not want it if you've actually seen it, but that's at the bottom of the range. At the top of the range, $34 million. That was the most expensive house listed at the end of June of 2024. That's a really big range. In fact, that tells you a lot about why we use median price when we talk about real estate, right? Because if you think about the distribution, 140,000 to 34 million, that distribution of houses is kind of bell-shaped, but it's not really bell-shaped. What it is, it's a skewed distribution. So we've got the median, the top, the most houses listed. In fact, it's half of houses are listed below the number and half of houses are listed above the number. Half of houses are listed below 575,000, 574,900, right? All the way down to 140. So there's about a $400,000 price difference there between the least expensive and the median listing. But then from 570 all the way up to 34 million, we have the other 50% of houses. What that means is the distribution is skewed. In fact, we can talk about the right tail is kind of cut off. It doesn't go to zero, it's cut off at 140,000. The left tail is long and narrow, right? The distribution comes down and goes long and narrow all the way up to that 34 million. So if we were to take an average between 140 and 34 million, we would get some number that's way higher than what the average price is in the data set. So we talk about medians, we talk about half or less and half or more. That's why we use a median. So that's the first thing I want to talk about, the range, right? We know the median, we know the range. That tells us a lot. But let's look inside that for just a little more insight. So let's look at the 10 least expensive houses. 140,000, that's the least expensive. The next least expensive house was 180,000. So if you missed out on that 140, you're paying a lot more, $40,000 extra to get that next least expensive house. Well, if you miss out on that one, the third least expensive house is $235,000. That's actually exactly half of the median list price. So 3 houses in, you're already exactly half of the median list price. For those of you who might be thinking, I'd love to pick up a single family home for less than 200,000, you've only got 2 shots at it. And everybody else might be thinking they want the same thing. So that's it's kind of like the unicorn. It's pretty much mythical. That's not where the Las Vegas housing market is. All right, so the third house was 235. The fourth house, 255. The next house, 260. The next one, 266. Then there were actually 2 of them listed at 270. And the 9th and 10th least expensive houses were also both listed at 280. It's actually twice the least expensive. So you get to the 9th and 10th least expensive houses, they're twice the least expensive house. So that means that right tail is going up really steeply and probably leveling out closer to that median sale price of 470 as opposed to the median list price of 570. So kind of an interesting thing to note. All right. We can do the same thing, price per foot, by the way. There's one other statistic I want to give you, and that is days on market, right? And so days on market are effectively the date from when something is listed until it goes into contract. And the longer that time frame, that means the longer something's been sitting out there. There's a problem with the statistic days on market, and that is it can be gamed. There are some real estate agents who think, if I go over 40 days on market, I'm going to take the listing down, relist it with a new MLS number. And so it reports on the MLS then smaller days on market, right? Because it was just newly listed. It doesn't matter, it'd been over here for a year for sale. I've only got 1 day on market because I just relisted the property. So Las Vegas Realtors has come up with a cumulative days on market to try to overcome some of that gamesmanship. So if within 30 days a property is relisted with the same agent, the numbers will just continue to accumulate under the cumulative days on market. So that actually becomes a better statistic, but that's gameable as well for a seller. If they trade real estate agents, that number resets to 0, or if they hold their property off the market for 30 days, the number again resets to 0. So an existing agent and a seller could decide, you know what, let's pull off the market for a month. Maybe we'll do a couple little things to it and we'll put it back out there. Days on market resets to 0. So it's still discoverable, but it takes manual effort to discover it. Anyhow, I'll just tell you the days on market numbers, right? Which, remember, they're gameable. Days on market for the first half of 2024, so basically reported June 30th, 2024, ranged from 0 to 1,302. Remember, again, this is a gameable number. And in the really low numbers, you have to think, well, it's not actually to the point that a house went into contract. If it's 0 or 1 or 10, that's actually to the current date. So if a house has not gone into contract, that also sets the end point. So days on market is to when a house goes into contract or the current date, whichever that is. So a house that shows 30 days on market but has not yet gone into contract was listed 30 days ago. A house that shows 30 days on market that was listed 45 days ago had gone into contract 15 days ago. So I'll just point that out to you. So the number requires some level of understanding about what's going on here to interpret it. But the 1,032 days, that's 2 years and 9 months approximately. So even though there's very low inventory and even though prices are going higher, some things are not moving at all. So that's just kind of some interesting information with regard to supply, right? These are listed properties that are in supply. So some of the things that are listed as supply maybe don't look really good. Maybe nobody's ever going to buy it. Maybe they're completely mispriced, or maybe they've got substantial fire damage and should be torn down. Some properties listed, for whatever reason, are sitting there really long days on market. So the inventory numbers, which are already weak, may actually even overstate what the supply is. So just know that as it relates to overall market conditions. Okay, so those are some of the internal statistics about what's happening in the market in the first half of 2024. So as we review the market, sort of the first half of the year, pricing, that's the most important factor when we do this kind of review, up almost 10% in the first 7 months of the year. Will pricing continue to go higher? Well, what determines pricing? Demand. Demand is low. It's a little stronger than last year. If interest rates come down, certainly there'll be more demand. Interest rates have not really been coming down, but interestingly, buyers are still materializing and they're still buying, and they're buying at a little bit higher rate than they did last year. So prices have continued to go higher. That could certainly happen. Now there's some macro conditions I'll talk about in a second, but that could certainly continue to happen. So prices could well continue to go higher. And if interest rates actually start to come down, prices could start going a lot higher. So at least year to date, my forecast of 20% price appreciation for single family homes in Las Vegas Valley, we're actually not looking that bad. I don't think we're going to continue at this same pace because of some of those macro conditions I'll talk about in a minute, but we're way above a normal appreciation, or appreciation for a normal year, which is between 5 and 7%. I also had predicted transaction volume would increase, partly because transaction volume was so low in 2023, and partly because I predicted interest rates were going to be coming down. Interest rates have not been coming down. Transaction volume has increased, but only 2%. Transaction volume will not be as strong this year as I had believed last November that we would likely see this year, just because of the interest rate environment. So supply continues to remain really low, and affordability, because of high interest rates, remains constrained. And so that's keeping a damper on overall transaction volume. How does that imply that we're going to look into the remainder of the year? So this is where I want to start talking about some macro conditions, because otherwise we'd continue along at basically the same pace. And my 20% increase in prices would be pretty close to the reality at the end of the year. But interest rates remain quite high. Interest rates may start to come down when the Federal Reserve has its September 18th meeting. At that meeting, the Fed may, it looks likely, but it may not happen, the Fed may lower the policy Fed funds rate. If they do, that's going to pull the entire interest rate market lower, and so mortgage-backed securities will go up in price to try to get showed high demand on bonds, which is going to pull mortgage bond yields lower, which is going to pull interest rates lower. But it's not going to be fast that we see rates coming down. It's not going to be substantial. We see rates coming down. We could see rates at like 6.5% by the end of the year. I'm not really now thinking we're going to see anything lower than that. Now, I will tell you with the Fed, they're very sensitive to the idea of people being concerned that they may be trying to manipulate the political environment. The Trump campaign has already been yelling at the Fed, do not lower interest rates before the election because it may stimulate the economy. It would be really bad policy, but Fed members are concerned about the appearance. So they may have a lot of pressure on them at the September meeting to keep rates where they are. It would be really bad for the economy. Hopefully the Fed does not feel that pressure and does what's actually appropriate for the economy. The economy clearly is slowing down. Employment gains are slowing. Inflation rates are coming way down. And so it would be completely appropriate to lower rates at the September meeting. The problem is it would have been appropriate to lower interest rates at multiple earlier meetings in 2024, and they've not. So we don't know exactly what they'll do. They're not going to increase rates in the September meeting. They may lower them. That would be good. The meeting, the Federal Open Market Committee meeting, the FOMC meeting, at which they may change interest rates after the September 18th meeting is one day after the federal election. So we could see the Fed hold on and wait until after the election and lower rates immediately after the election, and they could do it again in December. So it's possible we could see 2 interest rate cuts this year. I'm going to predict that the Fed will lower rates in September and not do so again until December, and so we'll have 2 rate cuts this year. But the December rate cut, the year is almost over, very little will be going on. We're in the holiday season, so that's going to have very little impact on the housing market to begin with, right? We know November and December are always the slowest months of the year. People are in holiday season, traveling season, and so that won't have much impact this year or any year. Okay, so interest rates remain high, and that's putting a damper on both the supply and also on demand. Beyond that, we see this year in 2024, as we go into the back half, the second half of the year, significant uncertainty materializing around the presidential election. Good, bad, or otherwise, it just is what it is. There's a lot of uncertainty. And if this turns out to be like 2020, we're going to have uncertainty about the electoral outcome from the date of the election all the way through the end of the year. People and businesses tend not to like major investment decisions in high uncertainty environments. And so the electoral cycle is inducing uncertainty that could slow transactions through the remainder of the year. So we've got interest rates not helping. We have an electoral environment which may actually slow transactions. We also have Congress is left on its August recess as of a week before August, and they've not passed any of the budget bills that are required for the new fiscal year that starts October 1st. So we could end up having a government shutdown. I'm not predicting it, but I'm certainly not predicting we won't have it either given dysfunction in Congress, we could end up with government shutdowns occurring in October and perhaps through the entire election. So that uncertainty exists as well. So there's economic/fiscal uncertainty, there's economic/interest rate uncertainty, and there's macro political environment uncertainty that are coming into existence for the remainder of this year. That could slow transaction volume, and in fact, I'm going to make the prediction that the second half of 2024 will see slower transaction volume than what we saw in the first half of 2024. That doesn't mean the prices are going to be going down, because we're going to see inventory probably going down as well as sellers decide they're going to pull back from the market. And therefore, those who need to buy will be confronted with less inventory and a willingness, even in the high interest rate environment, just as we've seen in the first half of the year, will continue to buy. And so that's likely to push prices higher on lower sales transaction and with lower inventory. So my transaction volume prediction that I made last November for 2024 will be quite substantially off. My pricing prediction is I made last November. We're going to be approaching, I don't think we'll actually hit the 20%, but we're going to be approaching. Okay, so there's something else that's happening in the macro environment, which is a second issue that I want to talk about in this video. And that is right now, literally right now, either as you're seeing this or as I'm recording this or in the couple weeks prior to my recording this, the real estate industry is undergoing a very substantial change. So here in the Las Vegas Valley, the Las Vegas Realtors Association, LVR, made this change effective as of the last day of July. Nationally, this becomes effective by the 17th or the 24th, depending on which particular entity you're talking to at which particular moment in time, of August. So before the end of August, this change will have rolled out across the entire country. What's a change? There are two seemingly small technical changes. One is all buyers must be represented under a buyer brokerage agreement called whatever, with the agent that's showing them any property before they can even go and look at a property. The other technical change is the sellers used to be able to offer through the MLS what was called a co-op. That was the offer to pay a buyer's agent's commission. So when a seller sells a house, they pay the listing agent, their own agent, a commission. There's a buyer who's most of the time represented by a buyer's agent. Well, the buyer's agent needs to earn a commission as well. They can't work for free, they just would starve. So they charge the buyer, but the buyer is usually compensated by the seller under what's called a co-op, a cooperative commission being paid by the seller to the buyer's agent on behalf of the buyer. That's the way this has worked in real estate since the 1970s. Well, it may still work that way, but information about it is becoming non-transparent. So there's been some litigation, and over the past couple of years, the litigation was badly decided by what I would suggest is a corrupt judge who doesn't understand anything about the law, giving really bad instructions to a jury who, after watching lots of HGTV and Bravo shows about $1 million listings, started thinking, oh, real estate agents must make a whole lot of money and therefore they're overcharging. Well, in reality, in Las Vegas, we have something on the order of 20,000 real estate agents. And in the first half of the year, we had 12,000 transactions, which means most real estate agents had no transactions, or maybe one. So real estate agents can't actually be making a lot of money in most of the environments around the country. So the hyped shows that you watch, the reality TV, right? Just like Survivor Island and whatever other reality shows there are, they don't actually comport to any form of reality. Most real estate agents actually don't make very much money. Most actually, a very significant percentage, I don't know it's a majority, a very significant percentage of real estate agents actually have second jobs to be able to feed themselves and put gas in the car. Irrespective of that, the settlement that came out of this litigation was sellers can still pay a co-op, but those co-ops can no longer be posted onto multiple listing services. So when a buyer's agent is looking for a property on behalf of a buyer, it's no longer recorded anywhere whether or not the seller is going to pay a co-op or what the size of the co-op may be. Now, this is a challenge, right? And we can think about this in terms of transparency. And over the past 10, 15, 20 years, no one I have ever heard has said we need less transparency. But that's exactly what's happened. We've had about 8 fields of information literally removed from the multiple listing service here in Las Vegas, and similar thing is happening by the end of August all across the country. With the removal of those fields, not only isn't it discoverable by looking in the MLS or trying to hack around and find a way to find it not publicly posted in the MLS, it's not there at all. Because it's not there, it's not been asked about, it's not been recorded anywhere. So the buyer is going to have to pre-promise to pay their agent all of their commission. Well, what does it take to buy a house? It takes a down payment, it takes closing costs. Those are dollars out of buyers' pockets. And a lot of buyers don't show up with lots of spare dollars in their pockets. So they may not have the money to be able to pay their agent themselves, which means that they have to rely on a seller paying their agent. Well, some sellers are going to think, if I don't have to put this into the MLS, I'm not going to offer anything. If they don't offer, buyer's agent may not get paid, which means buyer's agent can't show that property. It means fewer showings on this property, which means this property is going to sit here longer, may not sell, or may end up coming down in price. So the solution on this, the actual settlement solution, is probably going to slow the market. We'll work through it, and eventually we'll figure out how to make the market work in real time for buyers and sellers, for buyers agents and sellers agents. But it's going to take a while to get there. There's going to be some real confusion. There's going to be pushback on this change, and it's likely to slow the market. So this is another macro issue that will slow the market. Now, remember, buyers now need to sell a buyer broker or representation agreement with their agents before they can see any house. This is interesting as well. I've always done this with my buyers. I think it's professionally the best thing to do. I run a business as a real estate agent, so I don't just go show things, right? I develop business relationships with people. I have them sign a contract with me, and then we go and look. But in the new buyer's broker agreement, actually true in the old one, had to get the amount that the buyer was going to pay their agent. But it was disclosed in the old brokerage agreement, same in the new one, that the seller may pay a portion or all of what the buyer was obligated to pay the buyer's agent. Same thing right now under the new forms. It's just that what that is no longer visible in the multiple listing service, which means it has to be uncovered, it has to be discovered, which is harder, right? And this discovery process induces what's referred to as friction in the marketplace, and the more friction there are, the slower the activity in the marketplace. That's the economic consideration or statement about how that works. But there is something else that happens here. Because the buyer brokerage agreement must be signed before any showings, and because the buyer's brokerage agreement notes that the buyer is obligated to pay the buyer's agent these commissions, A buyer's broker who's working properly now needs to get prospectively not just these documents signed, but also proof of funds from the buyer so that the agent knows that the buyer can afford this property, this down payment, these closing costs, and these commissions, as well as, if needed, a pre-approval letter, right? In the past, you might figure, these properties all show, they didn't need to, but they all show some positive co-op being paid. The buyer doesn't have to come up with all of this commission for the buyer's agent. Now we don't know that whatsoever. So the buyer, we're going to have to make sure ahead of time the buyer can pay all of the commission that the buyer's agent wants to charge and that the buyer is willing to pay to their agent on a property of a particular price. Well, what does that mean? It means that if you think about in a grocery store, you get at the end of the aisle, I think they're called end caps, you get the salsa and the chips and the other high value things that supermarkets want to make sure you see, even if you're not walking up and down every one of the aisles. Catch your eye, cause you to want to buy on the spur of the moment, a serendipitous transaction. We've made the serendipitous transaction for buyers harder. We can't just be, hey friend, we're out doing this and there's a for sale sign there. Do you want to go look at that place? Sure, but there's no buyer broker agreement that's been signed yet. There's no ability to show it, right? The serendipitous transaction is probably going away. How many houses were bought under the serendipitous transaction? I don't know, but it's non-zero. And I know it's non-zero because most of the properties that I've bought have actually taken place exactly that way. Without having a pre-approval letter, without having a specific intent to purchase, but being in the right place at the right time where we've been able to go look at something and it's like, that seems like a really nice thing. Let's go ahead and do it. And it's happened with some of my clients as well. And so those transactions likely go to approximately zero. That's going to, again, take transactions out of the market. So through the end of this year, we'll be getting used to this new way of engaging in the activity of real estate, slowing the market. We'll be having uncertainty associated with the political environment, slowing the market. We'll have uncertainty associated with the financial system for the government, whether or not there'll be a government shutdown, slowing the market. And we'll be maintaining a relatively high interest rate environment, slowing the market. So looking forward through the end of 2024, I think the market will slow further. I think prices will continue to go up. I think interest rates will not be particularly conducive to transactions. I do think 2025 will see some significant changes in that, irrespective of how the political uncertainty ends up, irrespective of how potential government shutdowns end up. But we've got to get through a highly uncertain period of time to the other side of that before we actually start to see that pick up. And so I'm not making any predictions for 2025 at this point in time. Okay, so those are the things I wanted to talk about. I wanted to give you a couple proof examples. I wanted to talk about where we are in sort of the first half of the year review, and I wanted to talk about this big change that's taking place in the real estate industry. And the big change is actually really big. It's gonna have some real material impacts on how we engage in the activity of real estate. For sellers who think they're going to sell their homes without helping buyers, it's a nice thought. It's highly unlikely that on average that actually works out because most buyers just don't have all this extra money in their pocket. They need the assistance. And so prices of houses are higher than what they would be if sellers didn't have to give that assistance. And so either sellers are giving that assistance or prices are going to come down to what buyers can actually afford when they have to take on these extra costs that they've largely been protected from in the past. Okay, so that's it. I'm Justin Miller with the Chung Miller Group. Please share these videos with your friends, your neighbors, your friends, your colleagues, anyone you think might get beneficial knowledge or use out of these videos. And please feel free to comment. I'll respond to all comments, subscribe, hit the notification bell so you get further of these videos as we go forward in time. I look forward to seeing you in the next one. Thank you very much. Bye-bye.